First, the Chartmaster says there could be trouble brewing as the S&P 500 hands in its second straight week of losses. Let's kick things off with Cornerstone Macro's Carter Braxton Worth. Carter.
Sure. Well, in a way, it's amazing because a lot of stocks are down 10 and 20% from their highs, and yet the S&P, of course, is down only 2.5, 2.8. So not much has happened. But the question is, what can happen? Let's look at a few charts. So the first, it's the chart that anyone can draw, that I can draw. Everyone's entitled to draw it. It is the chart of the S&P with the trend line in effect since the pandemic low. Now, look at the second chart. What's happening here, of course, is we have been ascending this trend line, and it is very close to, on the short-term chart, the 50-day moving average. But you'll see that every time we've dipped, we've bounced quickly. This time we're dawdling. We're sort of biding time, not bouncing. And in technical parlance, it's something known as a diamond formation. Well, take a look at the third chart. This is without the trend line, and it's trying to annotate or highlight this sort of debate. You get your drawdown, not much, and now there's a standoff between people saying, hey, should I buy the dip as I've done every other time, or maybe this is different? And so that formation, there are some rules to this, if you will, rules of thumb, and let's talk about them. Next chart. A measured move from any formation, whether it's a head and shoulders or a consolidation range, is something that's very efficacious. And the width of this diamond, for lack of a better phrase, the high is 44.85, the low is 44.25. That's a 60-point range, and we basically are right at the low of that range now. In principle, a break to the downside, that's my judgment, is well, likely to take you exactly 60 points lower. Look at the final chart. So a measured move, a move that's the same magnitude as the width of the diamond, would take you down 60 points from the low point, or 43.65. Not that much, that's 5%. What that would take you to, however, is about where the 150-day moving average comes into play, and at that point, we would have a peak to trough decline of roughly 7.5%. It's my judgment that that's what's coming.
All right, Carter, thank you. Carter Braxton Worth, see you on Options Action. Pete Najarian, what's your take? It was Carter's judgment. The market goes lower. What's yours?
Well, it certainly could, Mel. I always track, as you know, the volatility index, and I've been watching it all year. We started at 25, we pulled back, then we spiked up over 40, we pulled back again. And I just continue to look at the volatility index in terms of where are we right now with the volatility index in terms of can we get over 20? Can we sustain over 20? We have not been able to do that, and I think that we've had a very healthy rotation all throughout the year, quite frankly, where you look at materials are leading, then it's energy, then it's technology, maybe it's semiconductors, maybe it's housing. It could be almost any sector. And as we take a look at all those sectors, most of those sectors are very close to the highs where they are coming off from. So does it make sense that there's a bit of a pause right now, Mel? I think so. And every time I look at the volatility index and it spikes over 20, lately, over the last 2 or 3 months, it can't stay up more than maybe 48 hours before it pulls right back down again. So for my money, I still continue to look at that index, and it's telling me right now that there are different leadership all the time. And because of that, I think when we get back in those teens, I think you can own very inexpensive protection to the downside. But I continue to be very bullish about how the market's moving because of that healthy rotation.
Yeah, Steve, what's your take?
Yeah, so Carter touched on a couple things. Pete touched on a couple things. So starting with Carter, if I look at the chart of the S&P cash or the S&P as Carter was looking at, I capture the same thing, right? He started off the segment saying anyone could draw that chart. It's basically up and to the right. We see the same laddering. We see the same spreads between the 50, the 100, and the 200. So, and where he finished off was what I liked about it. He said, we're really only talking about fractions lower. So if you're talking about fractions lower, the peak to trough will be about 7%, I believe he said. If I look back to the chart from October to November of 2020, it was 8% peak to trough. We touched that 200-day, or I should say the 100-day. That's what he thinks is going to happen, or that's what he said is possibly due to happen. I see the same thing. But when we're talking about where we are right now, we're only talking about a handful of percentage points. Nobody on this desk and nobody really in the trading world is going to be able to turn around their ship that quick. Even for a 7% move, it was a handful of days that we were down below the 100-day moving average. So you can't react that quickly. Having said that, Pete named the switching from cyclicals to growth. If you talk to every money manager, they're all doing the same thing right now. They're buying large cap, they're buying utilities, they're buying defensives. Seems a little overdone. Everyone's on the wrong side, or I should say everyone's on the same side of the ship. But I do believe the biggest thing that happened today was looking at the 10-year. 10-year is ratcheting up. This is the first time it's bounced off the bottom. I think we're heading back to 1.5%, 1.6%. I know, wow, woohoo, everyone put your party hats on. But I think then the Russell can overtake, so you're going to see that switch back into cyclicals again. But that could be trouble for the overall market.
Yeah, I mean, you saw the action today. Grosso mentioned the ratchet higher in the 10-year, and what did we see? We saw the NASDAQ 100 underperforming the NASDAQ. So really big cap technology being impacted by this move in rates. Karen, do you feel like this is going to be the story going into the year, into the end of the year, in terms of a sort of this tug of war? Rates go higher, tech has trouble, the overall markets have trouble simply because of the overall weighting of tech.
Mm-hmm. Well, I think, we always think of the market as this sort of monolith, but obviously it's made of a lot of different stocks, so there's a lot of things that can do well, others less well. To me, it was interesting how hard the FANGs got hit today, even harder than some of the high flyer names in the tech space that I would have thought, you see rates up, that we would see more pressure on those real high flyer ones. So, as Steve said, it's very hard to sort of trade around these things. Pete can do it. That's what he does. That's what he's great at. But for me to try to trade around my book to figure out when is the right time out and when is the right time back in, and did I do a good enough job trading in and out to make up what I would have to pay in taxes, I don't have a lot of confidence that I'll be able to do that. So a day like today is not good for me. FANGs, I have a big Alphabet position, big Facebook position, Microsoft, Apple, none of that worked. Industrials, that didn't work either. Even with rates up, banks really didn't work either. But I don't think things have changed materially. I still think that Delta's important, and that if we're really seeing a decline there, then we're going to, I think, see higher rates and a higher market.
Yeah, I mean, to Karen's point, IGV, the software ETF, down only 0.7% today compared to what we saw in FANG. Jeff Mills, what did you make of today's action? What do you make of just sort of the overall market in terms of where we are in this massive run going into the end of the year at this point?
Well, first of all, I agree with Karen in the sense that I would have thought that the higher flying names would have got hit today. We talked a little bit about it last night, but I think even in growth, you want to be quality. That's more FANG than some of the reopening names. So I definitely agree with that. I think that was maybe out of step today and won't be the trend going forward. But overall, I find myself agreeing with Carter because, as you all know, I've been in this cyclical camp for some time, and we've generally been in this momentum no man's land in the market. You've got 48% of stocks in the S&P trading above their 50-day, kind of meh. You have the S&P, you have Triple Q seeing really aggressive inflows, but then on the flip side, you've seen really aggressive outflows from cyclical. So if you do see this rotation, I could see damage at the index level. And that's what I would anticipate here going forward. As rates rise, again, we see this rotation. So I don't think the damage is going to be significant because the market has been able to go back and forth successfully between value and growth, just to use broad factor exposures. But I do think going forward, there's opportunity if you pick your spots. Karen mentioned COVID. So leadership has almost moved in lockstep with COVID counts. And I think we're likely moving into a better situation there. I thought University of Michigan was interesting today in the sense that the expectations component was up 2 points. So I think consumers are maybe starting to see that too. So I want to look outside the S&P 500. Steve mentioned small caps, the Russell 2000. If you look at the average mega cap stock, it's 14 or 15% above the 200-day. You go down the cap spectrum, that percentage above the 200-day moving average starts to come down. Small cap flows were liquidated. You're seeing those recover. So that's where I think the opportunity is.
Yeah, where's the opportunity in your view, Pete?
Well, Mel, when I look at technology, and everybody's focused obviously on a day like today, they say, wow, Microsoft pulled back, Apple pulled back. I actually look at a lot of these names, and I think they're in this pause phase that they've hit many, many times in the past. And I think that's going to be the next level when, after they get out of this pause, to maybe make those moves to the next level. I take a look at Microsoft, trading right around 300 for a couple of weeks now. Like, take a look at Apple. Yes, it spiked above this, but 146 to 148, it's still in that sort of range right now that it doesn't really bother me that it came off of the highs at 157. And then I look at something like NVIDIA that continues to trade right at 220. It seems like it's been stuck there now for a couple of weeks. So I think that there's some bullish signs to me, Mel, when I'm looking at technology that, of course, when you start to see those rates go up, yes, everybody starts to move away from technology because that's been the trend to do. But I tell you what, I look at technology as, all right, the pause is there, and then I think the next level is up. I don't see it being a downside push unless we start to see something that comes out, of course, with Delta and with the COVID-19 and all the rest of that. That always is something that's going to be hanging behind us now. But if that comes up, sure, we can have some sell-off, but I actually don't anticipate that, and I still think that those pauses are very, very healthy, and I think the next move is going to be higher.
What's on your watch list, Karen, in terms of things you could possibly buy if we do see some sort of a pullback?
Well, banks, which I own, it would have to be sort of a meaningful pullback for me to buy more banks. I don't really anticipate that happening. There's some retail that's sort of, kind of been sideways to down a little bit. That would be maybe interesting to be something like Starbucks, which, not having a great week. If that came in a little bit more, that would be something I would buy. So that's sort of what's loosely on my list right now.
Yeah. Loosely on your list, Grasso, is what?
Chemicals, materials. I think that you're going to see industrials rally. There's two reasons why the stock market's been under pressure. It's been COVID and China fears, and both of them are probably overextended. Today we had Quad, which that puts everything into question as far as volumes, but I think you're going to see all those names rally back in short order.